This is a lecture on Chapter 5, and the topic here is inventory. So up to this point, we have looked at accounting for service companies. Now we're going to consider merchandisers, and as a result of that, because we're introducing physical goods, we're going to see some additional accounts. Alright, so a retailer, and the example they give us here is Office Depot. Office Depot buys inventory from their wholesalers, and then they sell them to the customers. So in essence, in this case, Office Depot acts as their primary function is to buy and then sell goods. So of course their primary source of revenue would be sales. In this exhibit, what we have in a flow chart, if you will, is the basic components of the multi-step income statement. So we've said sales revenue is the major revenue for retailers. From that we subtract cost of goods sold. So in other words, cost of goods sold is what the retailer paid for the inventory that they have now sold. The gross profit is the excess of the sales revenue over the cost of goods sold. Another way of looking at it, it's their markup. We then have to subtract operating expenses from gross profit, and then we get net income. We're going to go into this in a little more detail further on in the lecture. Alright, now we have operating cycle. Basically what we're looking at is the time that it takes for a company to realize cash. So if we look at the service company, this is a mechanic. So the mechanic performs services, and we're assuming that they're not going to get paid right away, that they perform these services on account, and that they send the customer a bill. Alright, so they receive the cash, the operating cycle is complete, and now they have cash that they need to buy the parts to repair more cars. The retailer, on the other hand, they're buying inventory, and they then sell the inventory. And here again, they're doing this on account. It's not necessarily the way it works. And they wait for the collections from the customers. So once they've received the cash, they have completed their operating cycle. So for any business, they want to speed up the cash receipt as much as they can. And of course, the customers want to hold on to their cash for as long as they can. Right. This is a diagram that has the components of the cost of goods sold calculation. Right under that diagram, it says that companies use either a perpetual inventory system or a periodic inventory system to account for inventory, and that we're going to look at a little bit later. Alright, so if we take the beginning inventory, so what was left over from the prior accounting period, and add to that the cost of goods purchased, so it's what's purchased in the current accounting period, add those together, that gives us a cost of goods available for sale. In order to calculate the cost of goods sold, then we need to see what we have left over in ending inventory. We subtract ending inventory from cost of goods available for sale, and that gives us our cost of goods sold. Alright, here's an explanation of the perpetual inventory system. First of all, the perpetual inventory system is more commonly used than the periodic system because of computerization and of course the barcode scanners. So with the perpetual inventory system, records can be kept for the purchase and sale of each item of inventory. So what happens is that the inventory levels are continuously adjusted for changes as a result of purchases and sales. So what's happening is that each time the retailer makes a sale, the cost of goods sold is being recorded. Now in this course, we are not going to be preparing the journal entries under the perpetual inventory system. We will be doing the periodic inventory system only. But the information is in the textbook in case you want to look at it. Alright, now with the periodic inventory system, there are no records that are maintained during the accounting period about what inventory is available, the amount, the costs, etc., etc. So there's no attempt to adjust inventory levels for sales or for purchases, so that the cost of goods sold can only be determined at the end of an accounting period when a physical count of what's left over is done. Alright, so for the periodic system, we need to prepare the calculation for cost of goods sold as is shown on this slide. So I had explained this to you when we looked at that flow chart, but once again, to calculate cost of goods sold, we start with beginning inventory. We add to that the net purchases, which gives us the cost of goods available for sale. We subtract ending inventory, and that gives us the cost of goods sold for the accounting period. So now that we have that number, then we would be able to prepare the income statement. Alright, now advantages of the perpetual system. It was traditionally used for merchandise with high unit values. That was before computerization. It shows the quantity and cost of the inventory that should be on hand at any time, so it is now used for products that are mass produced, and it provides better control over inventories in a periodic system. Inventories represent a major commitment of funds, so it is wise to make sure that the business has what they need based on customer demand and in the amounts that the customer may purchase it. There may be some items that customers are not buying, and it would make sense to discontinue those. Alright, the next thing we're going to consider is freight costs. So in this chapter, we're going to be looking at a lot of terminology. So if you look at FOB shipping point and FOB destination point, FOB means free on board. So in FOB shipping point, the buyer is paying the freight cost. So that freight cost becomes part of the cost of the inventory. So that ownership of the inventory passes to the buyer when the seller delivers it to the shipper, so FedEx or UPS. On the other hand, FOB destination point, the seller pays the freight cost, and that the ownership of the inventory does not pass to the buyer until they receive it. So for the seller, those freight costs are categorized as an operating expense. Alright, so some other terms. Purchase returns and allowances. So, purchaser may not be happy with some of the inventory that they receive. There may be goods that are damaged or somehow defective. They may not be happy with the quality, or it may not be what they ordered. You know, the color may be wrong, the size may be wrong, etc. Alright, so, two options here. The purchaser opts to return everything that they were not happy with. If the purchase was made on credit and they haven't paid the bill yet, then they would get a credit on the account. If they did pay in cash, then they would get a refund of cash. purchase allowance, on the other hand, the seller may decide, well, you know what, I'll keep the merchandise. It's not so far off from what I had ordered, but they're going to look for a reduction in the purchase price from the seller. So it depends on whether or not this is in the best interest of the seller, whether or not they would offer that reduction in price. Alright, so now we're going to consider another account that has to do with purchases, and that's a purchase discount. As we said, we all want to maximize cash flow. So the seller wants to get the money from the buyer as quickly as possible. So they may offer them an incentive to do so. So in the little box we have credit terms, 2/10 net 30. That net 30 is a credit period, so that the buyer has 30 days to pay the bill without being considered delinquent. However, if the buyer pays within 10 days, they get a 2% discount off what they owe. So the purchaser saves money and the seller shortens their operating cycle because they're getting their cash faster. But the question becomes, is that discount worth it for the purchaser? Does it make sense for them to hand over their funds 20 days earlier than they have to in order to get this discount? Alright, here are some other examples of credit terms. So we talked about the 2/10 net 30. Now we have 1/10 end of month. So what happens here is that the purchaser will get a 1% discount if they pay the bill within the first 10 days of the next month. And what end of month means is that the bill has to be paid by the end of the month regardless of when the buyer received the bill. So let's say they get the bill on September 15th, they have to pay it September 30th. If they had gotten the bill on September 1st, they pay it September 30th. Alright, the net 10 end of month, what that is telling us is that the net amount is due within the first 10 days of the next month, which means that's their credit period. Alright, so we've looked at the purchase returns and allowances and purchase discounts. That's from the point of view of the buyer. Now we're going to look at this from the point of view of the seller. So sales returns and allowances, first of all, is a contra revenue account, which is subtracted from the sales revenue. When there is a return or an allowance, we do not reduce the sales revenue account because we would really not know the amount that is being returned. And that's important to know because we want to investigate why it's happening. Also, if we were to compare net sales from year to year without knowing what the gross sales are, that could give us fallacious comparisons, and we can make some bad decisions based on those comparisons. Alright, sales discount. It's just the opposite of the purchase discount. Like the sales returns and allowances, is a contra revenue account, which is subtracted from the sales revenue. So we have our gross sales of $3,800, sales returns and allowances of $300, sales discounts of $70. So we have net sales of $3,430. And it's from that net sales amount that we will subtract cost of goods sold to come up with gross profit. There are two formats for the income statement for a retailer. There's a multi-step and a single step. From an analytical point of view, the multi-step income statement is much more useful. And when you look at your company's financial statements, most of you will see that the multi-step format has been used. If you select a company that uses single step, then you will have to convert it to the multi-step format because of some of the ratios that you will have to calculate. So the multi-step income statement shows profit being calculated in steps, and we will go through those steps. And the multi-step income statement also distinguishes between operating and non-operating activities. So the next slide we have an example of a multi-step income statement. So if you notice at the top, we start off with sales revenue. We subtract the contra revenue account, sales returns and allowances, and sales discounts, which gives us our net sales. We then subtract cost of goods sold from net sales to give us our gross profit. Alright, so now we have operating expenses. And the operating expenses are expenses that must be incurred in order to run the business for the purpose for which it exists. Alright, so if you think of the college, what operating expenses must be paid? Of course, salaries and wages, maintenance and repairs on the buildings and other fixed asset, utilities expenses, insurance expenses, etc. Alright, so we then take the total operating expenses and subtract them from the gross profit. So in this case, we have income from operations of $30,000. This represents the pure profits of an organization. So what that is saying is that in this company, PW Audio Supply, whatever their business is, whatever they do, they make $30,000 doing it for year ended December 31st, 2017. Now, from an analytical point of view, what the finance and accounting people would want to do is that they would want to do a year-to-year comparison on the income from operations, among other things, to see how efficiently they're running their business. We also have other non-operating revenues and gains and non-operating expenses and losses. So, interest revenue would be income that would be earned from bank accounts, notes receivable. So in other words, if a company has made a loan to another entity or to individuals, and interest revenue earned on marketable securities. Dividend revenue would be dividend income that they receive from other corporations whose stock they have invested in. Rent revenue is another example. Companies not in the primary business of renting property, but they might sublet a portion of their office space. So that would be considered other revenue. Then gain from the sale of property, plant, and equipment. Assuming that the primary business of a company is not to be selling fixed assets, that gain would also be categorized under other revenues and gains. Now we look at expenses and losses. Interest expense would be associated with loans that PW Audio Supply have outstanding. Casualty losses would be losses that are uninsured. So the two examples I give is vandalism and accidents. Another loss would be the loss from the sale or abandonment of property, plant, and equipment. And finally, they provide another example: loss from the strikes by employees and suppliers. All right. So, once we have listed all of those non-operating gains and losses and non-operating expenses and losses, we take the other gains and revenues, add those to the income from operations, and then subtract the other expenses and losses. And in this case, we have a net income of $31,600. All right, now we're going to look at the single step income statement. What you're going to see is that this is a much shorter format. We're going to get the same net income. It's just the layout that is different. So, essentially what's going to happen is we're going to list all the revenues and gains together, regardless of whether they're operating or non-operating. Then we're going to list all the expenses together and losses, regardless of whether they're operating or non-operating. Now, they give two reasons for this single step format. Company does not realize any profit until total revenues exceed total expenses, and that the format is simpler and easier to read. That would be especially true for people that do not have an accounting background. But for those of us who are more sophisticated, it's not going to give us the information that would be the most helpful. In terms of the SEC, a company can use either format. The multi-step, however, is the more common format used. Alright, so here we have a PW Audio Supply. Once again, same income statement, different format. So net sales, we know, is an operating revenue. Interest revenue and gain on disposal of plant assets are non-operating. So we total up our total revenues. And then under expenses, cost of goods sold and operating expenses are operating expenses. Interest expense and casualty loss from vandalism are non-operating. So we total our expenses and losses, subtract them from total revenue, and we have the net income of $31,600, which of course is the same net income that we would have using the multi-step format. So that the net income should be the same. It's a formatting that's different. One other thing that I want to point out to you, if you go back to revenues and you look at net sales. So what they did here was they took the gross sales, subtracted the sales returns and allowances and sales discounts, and showed us the net sales, as opposed to showing the detailed calculation of net sales that we have seen in the multi-step format. Alright, so the next thing we're moving on to is the classified balance sheet. And the classified balance sheet is the proper way of putting together a balance sheet. So there are several different classifications, but right now we're only looking at two. One is current assets, and current assets are assets that are assumed to be convertible to cash within 1 year or less. Those assets are listed in the order of liquidity. So obviously cash will be listed first. Accounts receivable, we do expect customers to pay. Then we have inventory, and of course we expect to sell the inventory, which will ultimately be converted to cash and prepaid insurance. The other classification we have here is property, plant, and equipment. In this particular situation, we only have one fixed asset account, and that is equipment. When you have a depreciable fixed asset, the corresponding accumulated depreciation account is listed under the cost of that asset. So in the case of the equipment, the acquisition cost of the equipment was $80,000. the balance as of December 31st, 2017, and accumulated depreciation is $24,000. So if we subtract the $24,000 from the $80,000, we get $56,000. That $56,000 is the book value of the asset. So that we'd take that book value and add it to current assets to come up with the total current assets plus the property, plant, and equipment gives us our total assets. Couple things I want to point out. In each subsequent accounting period, when we depreciate, in this case, equipment, what's going to happen is that the balance in the accumulated depreciation account will increase, which will cause a decrease in the book value of the equipment, which means that the book value that we add in calculating total assets will decrease each accounting period. If you have more than one depreciable account, let's say we had a building, we would have an accumulated depreciation building account. So each depreciable asset would have its own corresponding accumulated depreciation account. There is one asset that is not depreciable, which we will mention again later on, and that is land. Land is considered or assumed to have an infinite life. So you might buy a piece of property and you might want to put up a brand new 5,000 square foot house, and it might just have an old barn on it. Obviously you're going to take down the barn. What you're more concerned about is that land. Okay, we're skipped over into Appendix B, where we're given more detail on the periodic inventory system. The information on this slide is repetitive of what we've already said. We've said that there's no running total for changes in inventory, so we're not making any adjustments. The ending inventory can only be determined by physical count, and so therefore the cost of goods sold cannot be determined until the end of the accounting period. Alright, so what we have here is we have the calculation for cost of goods sold using the periodic inventory system. So we start off with the beginning inventory, what we had left over from the prior accounting period, and then we're going to calculate cost of goods purchased. So we start off with the purchases made during the accounting period. We subtract any purchase returns and allowances and purchase discounts. And once we do that, that gives us the net purchases. So the purchases are net of the returns and allowances and the discount. Once we've calculated the net purchases, we add the freight in, because remember we said when the buyer is paying the freight, it becomes part of the cost of the inventory. So when we add the freight in to the net purchases, that gives us the cost of goods purchased. So the next step is to take the beginning inventory and add the cost of goods purchased, and that gives us the cost of goods available for sale. Finally, we subtract the ending inventory, and that gives us the cost of goods sold for the accounting period. So, when it comes to recording transactions using the periodic method, we record revenues when sales are made. We are not recording the cost of goods sold on the date of sale. We have to wait till the end of the accounting record, or period rather. The physical inventory account determines the cost of merchandise on hand and the cost of merchandise sold during the period. We record purchases in the purchases accounts, and we record purchase returns and allowances, purchase discounts, and freight costs in each of their own accounts. So we're going to look at examples of journal entries under the periodic system. So the first one, on the basis of the sales invoice and receipt of the merchandise ordered from PW Audio Supply, Sock Stereo records a $3,800 purchase as follows. They debit purchases for $3,800 and credit accounts payable for $3,800. So that means that PW Audio Supply will be paying them the $3,800 at a later date. All right. Now, in this particular situation, SOC pays the public freight company $150 for freight charges on its purchases from PW Supply Company. So then what happens here is that SOC will debit freight in for $150 and credit cash for $150. SOC Stereo returns $300 of the goods to PW Audio Supply and prepares a following entry to recognize the returns. So SOC hasn't paid PW yet, so they're going to debit accounts payable and credit purchase returns and allowances for $300. Alright, now we have an example of a purchase discount. On May 14th, SOC Stereo pays the balance due on account to PW Audio Supply, taking the 2% cash discount allowed by PW for payment within 10 days. SOC Stereo records the payment and the discount as follows. So they owe a total of $3,500. So they're going to debit accounts payable for the total liability of $3,500. 2% of $3,500 is $70. So they'll credit the purchase discounts account for $70. Subtract the $70 from the $3,500, which means they have an outlay of cash of $3,430. So they need to credit cash for $3,430. Alright, now PW records the sale of $3,800 of merchandise to SOC on May 4th, and they give you the information about the sales invoice. Alright, so the journal entry to record the sale. We're debiting accounts receivable, crediting revenue for $3,800. If it was a cash sale, we'd be debiting cash. Sales returns and allowances. So in this case, SOC returned some goods to PW, and PW records the $300 sales return. So the journal entry is a debit to sales returns and allowances of $300 and a credit to accounts receivable of $300. Alright, PW would like to speed up the cash flow. So PW receives payment of $3,430 on account from SOC. PW honors the 2% cash discount and records the payment of SOC's account receivable in full as follows. So PW offered that discount to speed up the cash collection process, and SOC took them up on that. So now, from the point of view of PW, they're going to debit cash for $3,430, debit sales discounts for $70, and credit accounts receivable for $3,500. Alright, so that's all we're covering in Chapter 5. And of course, there will be homework that goes along with the chapter, which of course is provided for you in Canvas under the module.